How was your hot dog?
Did you whatever you need, guy. Like whenever you feel like getting here. The people, they probably didn't even tune in yet.
So
wait. So what? It took you what 2 hours?
What is today?
It's Wednesday.
So Wednesday what?
December 4th.
Yeah. What does that mean?
Deck 4. Oh,
the tree lighting.
Oh yeah. Is
so
it Deck 4 or Deck 7? A day that will live in infamy.
The December 7th.
Yeah.
1941.
Was it over when the Germans bombed Pearl Harbor?
Okay. So what
movie?
No, I mean it's. I know what movie it is. I know what movie it is.
Insensitive? Too soon?
No, it's not too soon. The traffic. Well, from Thanksgiving until New Year's, the traffic into New York City is an abomination.
Yeah.
People that should not be allowed to drive. Big wheels. If you recall the big wheel when we were kids.
I do recall that. Yeah.
They somehow feel it necessary and their duty to drive into a place that they have no business driving into.
Yeah.
There are bridges, there are tunnels.
There's also a train and a bus.
There's a train and a bus.
From a lot of different directions.
No, but I'm sorry to interrupt. I apologize.
Well, thanks for coming.
But we don't do the thing. Appreciate it.
Welcome.
You should have to have a special license. No, I'm not even kidding around.
Guy, what would your platform be? Because there might be a mayoral.
It's funny. So last night,
so let's hear Guy Adami's platform.
Last night we were with Whitney. We weren't with Whitney Tilson. We saw Whitney Tilson at Anthony Scaramucci's book party.
Yeah, we did.
And Whitney Tilson is running for mayor. I'm like, if Whitney Tilson can run for mayor, why couldn't you? Christopher, I don't live here.
You'd have to live in New York.
I'd have to live in New York.
Can I tell you something about?
Here's my platform.
Yeah,
you need a special license to get. Forget about this congestion. I'll let you come in for free.
Yeah.
If you got the special license to get in.
Yeah.
And when I say special license, that means it's probably not scalable, but I'll do every effing road test to make sure.
Right.
And if you F up one thing, get out of the car, you're done. It's not 3 strikes, you're out. Like some of these people take their road test 8 or 9 effing times.
All right.
No, that's no.
But can we
you got one shot.
Can we go through the other pillars? The other pillars where
that's my first
pillar.
Kill
parades.
You should parades.
The parades are out.
Parades are bullshit.
They're
Nobody
out.
likes people in the parades. Don't like parades. It's the dope. Think about what a parade is. Think about it.
I just went to a parade.
And it sucked.
Here.
And you didn't enjoy it. Be
it
honest with me.
It was a little rainy and cold.
One other thing that has to go in this city are those street fairs. On
Done.
The weekends, they're
over.
So out.
Okay.
Do it in Staten Island. They need something going on out there.
You'd have to talk to your people because I think.
Well, who am I? When you say that, what does that even mean?
Yeah,
you think the mob runs this stuff?
They run.
I don't even know how to take that.
They run the street fairs. All right, guy.
Maybe the one in
we were just saying,
Little Italy.
We were getting a little punchy
no. The San Gennaro Festival.
Oh, that's awesome. I love that.
That's fine.
That one. Okay.
Yeah.
So,
but guy,
now we're gonna choose certain
because
ones
it's on one street. Nobody drives on Mulberry Street.
That's true. All right. So we were.
I
know you're fired up.
Wow.
No, but I see people like they're taking pictures of the effing Holland Tunnel. Like, why? If you can tell me who it's named after, then you can take a picture. Yeah, it's got the wreaths where the O's are.
Yes, right.
Well, you know what it's probably named after? You know, the first settlers of Manhattan, aside from Native Americans,
can't stand it.
Were the Dutch.
It's great.
We're the Dutch. It could be named after. You know what? Doug Cass is going to come in over the top on that one. All right, guy.
I apologize.
I just said to Liz.
I'm glad we got that.
I just said to Liz, the small cap suck. Okay, she was just trying to say, well, they're broadening out. They're up 18% of the year, you know, or nearly 20%.
In any of that, did I say buy small caps?
You gave me
I was making
side
a
eye.
point.
I know you gave me a little side eye.
I was trying to look at you. You're very close to me, so it turns into side eye.
Is that too much?
But I was making a point that the rally is just different this year, and that the gap between large cap and small cap is more narrow. Small caps are holding their own. It had been for a long time, and I had been the one saying it. They've made all these attempts 6 times, 7 times, and not been able to surpass.
Correct.
So it's a little different feel. Now, it could be that its vibes are overdone and the different feel is because we've gotten too speculative. Sure. I don't think we're going to hear the end of that in the next few weeks.
Yeah. It's interesting. So I'm sorry. I know, hey, there's a big move in the bond market earlier this morning. I mean, 10-year yields got up to like 429 or something. They've pulled all the way back. I think they're probably unchanged.
What was the
slightly
headline,
low.
guy?
I don't know.
Yeah.
And now people are speculating that I guess Jerome Powell is sitting with I think Andrew Ross Sorkin today.
Oh yeah.
So there's some
428
some
So
thoughts that maybe
418.
he's going to say something. So we'll see. I mean, we'll see.
Dovish.
Dovish. We'll see what happens. Anyway,
all right. Let's just be really clear on that. So if he says something dovish, that means that some of the data that they're seeing is weak. Is that what we can agree?
I think. Listen, I think that's fair to say.
Support, because he's made the point of supporting the jobs market, right?
I think the interpretation could be if in fact something is said that's construed as dovish, it's because of softening economic data, which flies in the face of other things that we've been seeing. GDP, Liz has talked about this as well. So there's a lot to unravel here without question.
Yeah, I don't know what the softening data he'd be referencing is, because we got JOLTS data yesterday and it was above expectations. So more openings than we thought. The quits rate is actually up again, which is actually a strengthening indicator. People are more willing to quit their jobs voluntarily. That had been something that had been weakening pretty steadily over the last few months, and it was something we were watching. Now, this is obviously just one data point that doesn't make a trend, but I don't think that there was any new data that Powell would be talking about in the last 48 to 72 hours that would make him more dovish. So it would have to be some kind of commentary just based on what they're going to do, how they're going to handle this cutting cycle. And we had gotten to the point where the December meeting was live, meaning it was almost a 50-50 probability. Now it's back up to 75% chance of a 25 basis point cut.
Did it get as low as 50%?
It got in the 50s.
Yeah. Earlier this week, it was like 62 to start the week off, I think.
But what you're seeing now, there were some comments by Waller earlier this week that sent it from, I think, the 60s up to 80. So that might be part of it. If Powell confirms what Waller said, then it's, December cut probably secured, and perhaps they pause early.
We have later this afternoon, we're recording with Courtney Brown.
Courtney Brown.
Courtney she's at Axios, and she is their Fed reporter, and she gets their question, Fed Chair Powell, during the presser. And we're really interested in hearing what her reporting suggests. Like one of the things that's interesting is that as we get closer to the new administration coming in, I think it's probably the easiest path for Fed Chair Powell just to continue on the path that he was on as far as cutting rates. Because let's just say he does nothing. Like, he's going to get blown up on Truth Social for the next month and a half. Is that fair to say? You know what I mean? Like, and then the next meeting is like the week before inauguration.
That's fair. So, I mean, again, I think he's probably learned a lot in his tenure as Fed chair. I mean, I think he's grown into the position when in 2018, he was probably 6 months into the job when, he did the about face. I think it was cruise control about the balance sheet.
It might have been a year plus. Did he start in early 2017?
I don't know.
Well,
but let's just say he was early in the tenure.
Yeah.
The market goes down almost 20%. The Trump administration, then President Trump, sort of browbeats him, gets browbeat by him. The market sort of reacts in a way that was unfavorable, and they reverse course. I think since that time, if I had asked him one question, it would be, do you regret what basically transpired from the fall of 2018 into early 2019? And if you have to do it all over again, would you have stayed the course? I think that's reasonable. And my sense is, although he probably wouldn't answer it, I think in the recess of his mind, he realizes, you know what? If I had stayed the course, we'd probably all be in a better position today. Again, you can't do the counterfactual. But to answer your question,
by the way, February 2018.
I was right.
Started that
so
rate
six
cycle.
Months, that's what I thought.
That's kind of quick to get in there and kind of.
So again, now if this incoming administration is going to sort of again beat him down, I think he'd sort of stay in the pocket and say, you know what, this is what we're doing.
Liz, that's a football expression.
She knows that.
Yeah.
She's
Drop back in the pocket.
There's some people. You say that to Melissa. That's one thing.
I know. Are you kind of an RPO sort of gal or what?
I don't know what RPO means.
Run pass option. That's the other thing, by the way.
Sorry.
I would eliminate
I did
that.
Not mean to. That was not cool.
By the way.
Anyway, back to Powell.
Hold on 1 second. Please give me 1 second. Please. If a quarterback decides to run, I think it's in everybody's best interest. Then you are fair effing game. And why do I mention this? Because now guys don't know what to do. Like, who's the guy? Mahomes on Kansas City. He totally games that shit out. Watch him, because he'll sort of do the thing and the defense, and then he'll keep. It's wrong. Now I mentioned that because Trevor Lawrence just got blown up the other day. Yeah. And listen, that was a dirty hit, without question. But defenders, is the guy going to slide? Is he going to keep going? Yeah. Once you decide to become a runner, effectively a running back at that position, Forget about this slide bullshit.
Well, hold on. But Mahomes,
no, hold on.
A big part of his game is doing some of that stuff behind the line of scrimmage,
and
then he pulls up and he makes some crazy sidearmy sort of
thing.
And
then watch him run down the sideline. I'm going to slide. I'm not going to slide. I mean,
okay.
You are, once you've established yourself as a runner, a running back, that's it. You can't, you want to slide, that's fine. Somebody's going to take your effing head off. Because that would, I think, again, now people know at least what the rules are. It's bullshit. And sorry. I don't even know how it got there. Oh, you mentioned run pass option.
No, just lay down and have a cup of tea.
You'll never forget the RPO right now. When you watch your Packers this weekend and you hear
Amanda mad at me, by the way. I don't have her in my ear.
This is the new look market call. We're changing
for now.
Oh, we are
for now.
Wow.
Until
anyway, Jerome Powell.
So he was 6 months into the job in 2018. The point I was going to make, rates were already on the rise. The thing that the market reacted to and started going down on was that he said the words, "We are far from neutral." That is the mistake.
I think there was an autopilot thing or cruise control thing as well.
And that is the mistake I don't think he will repeat again. So we are right now in a time where we're debating where neutral is. Everybody is assuming that neutral is higher than where they originally thought. It's possible that we hear comments from him or from the Fed in general that neutral is not, in fact, higher than we thought. That would be interpreted dovishly. So that could be something that we're hearing about today. But I don't think he's going to make that mistake again to say something about the neutral rate prematurely.
Guy, he's gotten pretty good on the communication.
I think so. I've said that.
Yeah.
I think he's done it. Listen, he's had some missteps, but they talk a lot.
Everyone has a bad day here and there. You know what I mean?
And again, I want to be, in terms of I'm not a fan of the Federal Reserve. I've come to appreciate what this man has done under what's been some really difficult times. I mean, if you think about it, I think that, listen, the whole transitory thing was a huge mistake. I think they were late to the dance, but through the lens of the stock market, at least, if that's the one thing you're looking at it, they've actually navigated it pretty well. I still think there's going to be some pain ahead, but I've thought that for the last 18 months.
Well, they've been warning us of pain ahead for a long time and said it's going to be necessary in order to get us to where we need to be. So I don't even think they would be affected by it if there was some pain. And that's where the market would have trouble with it. Because if you remember what happened on August 5th of this year, the market went down and suddenly people were calling for a 75 basis point emergency cut because the market was down.
It wasn't people. It was that little shit professor from the University of... No, don't be diplomatic. Because I called him out and that was embarrassing.
She's diplomatic.
That was... I'm not.
I know, but
that was embarrassing.
She's
and he embarrassed himself. What's his name?
Siegel.
Jeremy Siegel.
That's
what he was doing on TV, on live TV.
Yeah.
Which we are also on.
Yeah, but I don't.
You got all up in his grill within like 15 hours of that thing.
Maybe because it was embarrassing.
5 hours later, you did.
He embarrassed himself, which means he embarrassed the University of Pennsylvania.
My alma mater.
William Penn.
My alma mater. I mean, the one thing I'll say, like, he should not be on TV anymore. Like, who?
They like putting him on.
You know, anybody who's on a commercial for ETFs, like, you know, he's like the wisdom tree spokesman or whatever. Like,
it's a good word, wisdom. That's a word you don't use often enough. No,
you never hear it.
No, I'm not. I don't. I'm not. You rarely, if ever.
Hey, we got a lot to get through.
Sorry. By the way, mention we have Butters today.
We do have Butters. Really quickly, let's throw up. We have a webinar. Guy. I don't know if you heard this. It's
December 10th, 10 a.m.
If you want to help us out, go register for this. Liz is already registered. Guy and I are going to be moderating this. This is with the CTO of FactSet. It's with the CBO, that's a chief business officer of Perplexity. Perplexity, Guy, other than like OpenAI, is probably the hottest generative AI company in the Valley right now. So we're going to go through like how their technology is enabling companies like FactSet to integrate generative AI into a bunch of their processes. We're already using some of the stuff within FactSet. We love it. 10 a.m. Go to riskreversal.com, 10 a.m. on deck 10. That's Tuesday. All right, sign up. Guy, let's talk about some of these big moves that we're seeing after earnings. You know, you said this last night on Fast Money. We're looking at Salesforce's results, and maybe Amanda can pull this one up here. So that comes out CRM. Mark Benioff, this was actually really interesting to me. The CEO of this company, He came right at Microsoft. I mean, right at Microsoft. He said, go ask Microsoft employees if they are using Copilot. Okay, so it's Microsoft Copilot is based on the technology that they basically have licensed from OpenAI. Salesforce has basically integrated their own generative AI. They're calling them agents, and they're to help them, serve customers across their suite of platforms and stuff. Why is this stock up 10%?
Because of the excitement around the commentary. If you look at just the numbers, if you forget about all the commentary you heard, all the AI and the commentary I heard this morning from Mark Benioff's interview with Jim Cramer, they missed, and the guide wasn't particularly good. Which, when you're talking about the valuation the stock trades at, should have been lower, but it was all sort of the ancillary stuff around it, the hope of the future and how CRM is going to be a vital, integral part of this whole new generation of technology and workforce flows. That's what it is. Because if you look at just the numbers, it wasn't particularly good. The one number that I'll give them, the margin improvement was better than expected. Yeah. That's the one thing that stuck out to me. Short of that, I mean, the guide for the rest of the year wasn't particularly good, and that puts them at a pretty elevated valuation.
Yeah, Liz, before we get to the IGV, because I know you want to talk about the software ETF, one thing I'll just say about this is we talk about companies' visibility into their future, results all the time, and some are really good at it, and some just manage to little upside here and there. That means that they kind of make, the current quarter that they're in by the time they give the guidance. Look at this Salesforce here. It was down, I don't know, I want to say from 320 to after they reported a very disappointing quarter in late May, all the way down to 220.
Now,
just think about that.
So okay. Yes. Now, think about what was going on at the same time. That was sort of when, the AI explosion started happening. So investment dollars were leaving software. And flying into the AI trade. And not only investment dollars, but CapEx dollars as well, and they were taking the brunt of it. But as you pointed out, Elizabeth, there was going to be a turn, and that's what happened. Sorry, please.
No, I mean, so it's up 70% since then. I mean, this is not a small market cap company, and I just find it interesting that you had the sort of move that they had in late May. So what did they do? If the expectations came down for the last 2 quarters, they've been beating those lower expectations. And this is not a company that has rip-roaring growth, but to see 70% gains off of those lows in about 6 or 7 months, and now it's got a $350 billion market cap, and it's growing at high single digits, you have to believe that some of the stuff that Benioff is saying to you is going to increase their margins, right? And the company is ready to kind of see an acceleration in earnings and sales. So let's extrapolate it, Liz. Let's look at the IGV. It's up 3.5% today. Salesforce is the largest component of that. You're seeing a big catch up in a handful of other names. So here's Workday, which is down on the year. It's up 5.25% today. Adobe down on the year. It's up nearly 4%. And this goes to what you and I were just talking about a little bit before Guy was having his lunch down there at 11th Street.
I don't need, by the way, I don't eat those hot dogs on the street.
Oh, what are they? Gray's Papaya.
No, Gray's Papaya.
They still have a couple.
There's
of those
a Gray's Papaya.
There's one up in 72nd.
But no, the guys with the trucks, the dirty water dogs.
That's
I mean, you can imagine what that would do to me.
So Liz, there's a little catch up being played here. A lot of catch up being played here by underperformers within software.
Yeah. Well, and we talk about this too. Look, the technicals don't look great. I mean, if we're talking about Salesforce, you've got an RSI, a 14-day RSI relative strength index above 70, which is overbought territory. And a lot of these names are probably going to look like that. What we've learned this year, though, is that doesn't necessarily matter. We've seen entire sectors get into overbought territory and then continue running. So I do believe in software for a longer term period. And I do think in 2025, it has real legs to take over what semiconductors have been doing as the leader. Maybe not to the same magnitude, but I do think that rotation will continue. Some of this is a little much, right? Some of this is a little frothy. And when you look at charts that have a big gap just on earnings, we all know how that usually ends. So I would expect some volatility, especially in these names that have run up so much. And the IGV, as you point out, is up a lot today. I mean, on the list of stuff that I watch, it's in the top spot. So up almost 3.5% on the day because Salesforce is, I believe, its largest position. So there's a lot of enthusiasm in it. And I'm clearly not the only one who thinks that software is poised to do well for the next few months, if not the next year. Just because it's up, though, doesn't mean it can't continue going up. So if you just look at year to date, the IGV is up 35%, which sounds like a lot, and it is a lot, but compared to what some of the semiconductors are up, it's not that much. So there's still room if there's this much enthusiasm.
Guy, you buying this runaway breakout?
Well, the analysts are, and I am. In terms of Salesforce, no, but IGV, Liz has been right. And if you look at Oracle now, even Microsoft is getting off the mat a little bit. I mean, the IGV actually makes a little sense. However, this move in Salesforce, and say you're going to have, again, a big volume day, probably 3.5, 4 times normal volume. This is what the analyst community said. I mean, this is from Citi. They acknowledged some metrics were soft. However, they pointed to positive trends going forward. The other analysts, I think, RBC Capital, stability and subscription revenue. Again, acknowledgement that some of the metrics were soft. They raised their price target to $420 from $300. Stifel kept their they raised their price target to $425. So now you're in the analyst chase mode because they seemingly are behind the 8 ball. But understand that, you know, valuation at some point does matter. And regardless of what you say, I mean, that quarter, if you just look at it and start to break things down, X margins, I don't know. I wasn't particularly blown away by it.
Guy, that leads me to a comment that our friend Doug Cash just sent over. There's zero appreciation of risk versus reward, nor margin of safety. So I guess when you're buying these kind of runaway breakouts and, you know, on quarters that don't look great, on guidance that don't look great for no good reason, I mean, that's kind of curious to me. Let's look at Marvell. Okay, this is a stock that you and I talked about earlier in the week. We talked about how 10% of their revenues is really associated with, you know, generative AI and chips. And that's expected to go up a little by little. It's about maybe 25% next year, 30% in 2026. And you see this sort of move. I mean, this is, you know, not a small company. You see about a 20% plus move. It's a market cap of, you know, $100 billion. Just think about that on $102 billion. Okay. The upside that they printed, does it deserve, you know, 10, 15, $20 billion?
Okay.
You know what I mean?
So
like,
this
whatever
is
the number.
Again, so this is another one. So they announced a partnership with Amazon, and that's, you know, that is the headline that steals everything. And then analysts get behind it. Again, Oppenheimer, I think, raised their price target to 125 from 110. Needham, I think, raised their price target to 120 from 95. So you get that one data point, and in the case of this, it's the Amazon partnership, and you have a 20% move. Is it justified? You tell me. I mean, that's the world we live in right now. And this is, to your other point, this is not a small company. So you're clearly in sort of the froth stage of things, in my opinion.
Yeah.
Dan.
So let's talk about the earnings beat. They came in at 43 cents versus a 41-cent consensus, and then they're guiding to 64 cents on a 52 cents consensus. So to your point about the Amazon and the like, I mean, that's a big part of it. But let's just talk about this for a second, Liz. When you see this, I mean, listen, we've been doing this a long time. And I know that obviously you look at single stocks, you don't do a whole heck of a lot of analysis on their individual fundamentals.
No,
you don't talk. Yes, you do look at it. I mean, you're just, yeah. But when you see this sort of price action, you know, it like, I don't think it's bullish. Like, you know what I mean? Like, like how offsides are people when the stocks are trading at all-time highs and they gap up 10, 15% like Salesforce or 20% like Marvell, and they don't see a downtick. Now, that being said, Guy, I think you would agree with me. I think Salesforce fills in that gap pretty quickly. And you and I talked about that with like Micron and some other names. Marvel is a different situation because folks are dying to find names in the semiconductor space that aren't NVIDIA, that aren't Taiwan Semi, and they aren't, let's say, Broadcom.
Well, and I think that's what you have to search for. And this is the time of year where you want to position your portfolio for what you think is going to come in the next 12 months. And I think those are the opportunities that you want to look at. I know we're going to talk about some other stuff today. This is
You're hoping that we talk about some other stuff today.
This is a period where I think we've learned over the last 2 years, you know, we've been skeptical of this bull market. Everybody at this table has been skeptical of this bull market. And I'm tired of being fully skeptical. So this is a period where, are we going to kick out another 25% year? Probably not. But could we kick out an averagey year? Perhaps. And you want to make sure that you have a presence in your portfolio in some of the stuff that has done well and could continue to do well. But you also want to balance it with other things that either have completely lagged, maybe they're in the same theme, but they've lagged, or an entire asset class, perhaps, that you haven't had exposure to, just to make sure that you're not entirely offsides. Because I think the chance in 2025 of ending up offsides because of, for one thing, policies that perhaps don't come as true as people think they will, or just a continued rotation from investors into other stuff, is high. So you want to make sure that you're balancing things. Somebody like Brian Belsky will say, this is a year where you want to own a little bit of everything. Now, I wouldn't say maybe everything, but he'll say you want to own a little bit of everything. That's how you balance.
But you know what's funny that you say that? So Belsky was sitting in this seat about a month ago for the On the Tape podcast, and he said something really interesting. It's almost opposite. I'm not saying you guys are thinking about things differently. He's like, if you've been skeptical of this market for the last year and a half, he's like, because you're just so focused on the macro. Like, is that a good Belsky impression?
Yeah.
You know what I mean? Like he was getting hopped up. You know, you're letting the macro get you turned around, and this and that. He kept on saying that, which is both things can be true about what you're saying. I just thought that was an interesting perspective from a guy who always had like a high, you know what I mean, target on the S&P in 23 and 24. Let's shift gears, guy, because hold
on, before we switch gears,
we
got to do some questions on the fly.
Sure.
This is a good one. So somebody said, I think I can't get his name, but when did you switch from the 200-day moving average to the 150-day moving average? Throw that up on the screen. And what was the reasoning behind it? And this happened about 6 months or so ago. I think it was over the summer.
Yeah.
Where we finally embraced the fact that the 150-day moving average, according to Carter Braxton Worth, made much more sense than the 200-day. And he gave us some back testing that sort of actually played out and then sort of galvanized that thought. So that's why we switched from the 200-day. We like to evolve as well. As much as I am Neanderthal and I'm not really into evolution.
Neanderthal did evolve.
That's correct.
Over a long time, over time. But the Neanderthals at the time were Neanderthals.
Correct.
Anyway, so that was the reasoning behind it.
I read, Sam Harris has a podcast, Making Sense. I think he's a brilliant guy.
CENTS or SCNSE?
Yeah, it's not about markets. He has a founder of a company, I can't remember what it is, on his podcast this week. The company is a tech company, but it's focused on bioscience. They are trying to re-extinct or unextinct mammoths, dodo birds,
like Jurassic Park.
Dodo birds.
They actually reference, this is different than Jurassic Park.
Not really.
I'm reading this thing and I'm like, really? I thought that was really interesting. We got to hit this. Last night we were talking about Apple. We're talking about China tariffs, the tit for tat back and forth about, chips and this and whatever. And, Mel was bringing, this up, like, Guy, you mentioned it, who is most exposed, right? And we had Eunice Yoon, who's in from Beijing. She's a reporter for CNBC. And she was telling us, this was the other day, that, the Beijing, the leaders there, the less dependent they are, let's say, on an Apple for manufacturing, like the more they reshore or, that sort of thing. That's ultimately when companies like Apple and Tesla, who rely on, rare earth materials coming from China, that rely on their citizens to buy the products and stuff like that. That's when they sort of cast them out. Now, you made the point, Guy. We've been talking about this for how long?
The risk of Apple in China for a couple of years now. And it's all been effectively unfounded in terms of the stock. I mean, if you look at Apple, the stock, it had a couple sell-offs
this year. It looked like it was
did.
founded.
100%. But again, the market just seems to whistle past that. Now, again, those risks have not gone away.
Yeah.
They've only actually gotten worse. And this whole rare earths thing was sort of the last piece of the rhetoric train that's been going on for quite some time. And listen, I don't live in mainland China. But you have to study who your enemies are. And in terms of the economy, don't make any mistake. There are economic enemies and they play the long game and we play the short game. And if they had the opportunity to ram it up our, in the form of an Apple or Starbucks or a Nike or anything else, they're going to play that chip at some point.
Yeah. I mean, the thing about Apple, though, it's such a big, employer there. And so one thing that I went to, there was IDC had some data out about iPhone shipments are basically flat year over year. Android shipments are up 6% year over year. So Android has a price point, average selling price of $285. Apple has an average selling price over $1,000, right? So think about that. They own all the profitability from a handset standpoint around the world. Android has massive market share. And if you think about the next leg of intelligence, on the edge, on the device, that's where these companies are going to make their money. So I actually think Android phones could really take off a little bit. And the last thing I'll say about China is that Huawei and Xiaomi are number 1 and 2 as far as market share there. Apple's dropped to number 3. And all of this excitement about Apple Intelligence, how it's going to drive a upgrade super cycle, It's not happening. And then here's the information's reporting this today, that Apple, because one of the other things we said about Apple in China, it's never going to be, Apple Intelligence is never going to make it there. You're not going to have large language models from the US, you know what I mean, being able to be behind the paywall. And so this note from the information, and we'll put it in the show notes here, is talking about how they've hit a snag with Baidu, okay, with their large language models. All that being said, the stock's rallied 10%, just broke out to new highs. Does that make any sense to you, Liz, when you think about finally all of those concerns, you know what I mean, that people are having, and maybe they're becoming founded?
I mean, no, it doesn't make a ton of sense if that's what we're focusing on. But I think Guy made this point before. We've been worrying about this for a couple years, though, and it hasn't really hurt the domestic stocks yet. So perhaps it's just that we're extrapolating that out into the future. If we look at China just broadly, and this is probably a hotly debated trade right now, the way that I would think about China right now is that if a lot of the bad news is priced in, sometimes that's the right time to step in. And you have to look at this from a longer term perspective. Look, we know there's going to be trade wars with China. We know we're going to turn up the screws in 2025. We know there's going to be pressure, but I can also tell you they're not going to take it quietly. So there's going to continue to be this back and forth. My thesis on China and owning some of the ETFs in China, I'm long FXI and long KWEB being the more internet focused of the two, FXI being large cap China, so spread out among sectors. My thesis there is that they already started stimulating. They don't like that their currency is depreciating. They don't like that they're missing their growth targets. They're not going to give that up without a fight. So I think they're going to continue stimulating and continue the tit for tat thing until they can find some sustainability, until they can find some sustainable strength. So I own more of the FXI than I do the KWEB, because I think the KWEB companies are what will be targeted more by a trade war. FXI, if they are successful in stimulating, will benefit more because it could stimulate the consumer over there and kick up some more of those stocks in China.
Awesome. I will say one thing about the FXI, it is kind of heavily loaded towards some of the internet names, but it's obviously a lot more diversified.
There's just more in it. Yeah. You don't have to pick single stocks in China.
Where are we going, Guy, away from tit for tat? Well, what would be
eye for an eye, a very biblical thing?
Well, no, but that means more punitive. I think a tit for tat suggests that it's gaming. You know what I mean? It's like kind of like
I think they wanted to get away from the punitive and tit for tat, but it's very similar.
Where do you think tit for tat comes from?
I think it's from like the early 1500s or something.
Really?
That's a long time ago.
It's a word that's kind of been bastardized. I don't know. It's just like, I don't love the expression.
So here you go. We have another question, because this is what we do now. We filter questions in. This is a question. This is from another name. I don't know if that means
that was the other one too.
That was the other person.
$9.99 in the person's handle. So
well, he or she wants to know about a company called Pure Storage, PSTG, which just reported. So they did have a good earnings release, and the analysts got behind it as well. If Amanda can put up like a 5 or 6 year chart, you'll see we're approaching prior highs, I think north of $70. The average price target, according to FactSet, is $72.05, which implies a little more upside from current prices. A lot of analysts just sort of raise those price targets. Again, that's what the average is now. It's getting towards levels where, valuation, you're going to run into concern like everything else in terms of valuation. You don't have huge EPS growth. You maybe have like single-digit EPS growth, but this is one. If you want to play it for that prior high, as Dan would say, have at it, people. Now, I'm not expecting you to opine here, but I just looked it up now.
Yeah. I mean, listen, we talk about valuation. We talk about it relative to itself. We talk about it relative to its peers. We talk about it relative to the market. It's a tough road to hoe.
We have to get Elizabeth's note in, because I'm looking at the clock, and
Mario wrote the note this week.
Oh, yeah.
Mario.
Yeah. Him.
Well, I like the way you say it.
He's watching today.
My man. Can I say something to him? Is he watching?
Yeah, he is watching.
If you could do a single shot here, Mario, you do tremendous work. And I know Elizabeth is happy to have you on the squad, and we are happy that your work makes it on to the market call.
Absolutely.
So without further ado, that's French.
So we talked about on Monday, adieu is French.
Yes, I just said that.
We talked about on Monday that there was a lot of macro data this week. So what he wrote about in this note was basically what's the pulse on the macro environment. And basically there's still good news rolling in, and all of the data that we've gotten, or at least the majority of the data that we've gotten, continues to be positive. I mentioned JOLTS already. There's a chart on JOLTS. So job openings went up. We were worried about this sort of weakening. As you can see, these two lines had fallen pretty steadily. And now we've got this little pop back up. So this is a little bit of liveliness, we'll call it, in the labor market. Also, I will say,
is that seasonal? Could be seasonal. Or
could be seasonal, but this is not even election related. So the other thing that you want to watch here, this is obviously just one data point, but if this continues, it's likely to make the Fed more hawkish. So this is something that you want to watch if you're a Fed predictor. And then we've got a chart on CPI, which we've shown this one many times before, but still trending down. The sticky parts of it we know continue to be a problem: car insurance and shelter. And as long as yields stay where they are, shelter likely to stay a problem as well. One of the things, a chart that's not in this piece, but that we do talk about, and Mario reminds me of all the time, is the construction market. So when we're talking about shelter, you're thinking about the housing market. There are fewer units being constructed. There are less construction workers needed over time to build those units. If that stays the case, always remember that the construction labor market leads the broader labor market by about, I think, 6 to 9 months. He will correct me if that's wrong, but I'm pretty sure it's about 6 to 9 months. So if we start to see a really big slowdown in construction employment, that could be a warning sign for the broader labor market. So just a risk factor.
No, and this is great work. And you're going to look real quickly. We're going to look at the Atlanta Fed GDP model, which I think plays into this as well. But I will say this, your point about the Fed, I mean, whether they acknowledge it or not, they want the job market to soften without question. I think they would love to see somewhere between a 4.5 and 4.7 unemployment rate, which I think the market would accept, not be thrilled with. And therein lies potentially their soft landing. The rub becomes, will they be able to control it? And we have both talked about the fact that, you get this escape velocity at some point, which we saw earlier this year, the potential for, then things sort of backed up. So to me, that is one of the more important things to watch for, obviously, the remainder of this year and early next year.
Well, I think one of the misconceptions, because the labor market is one of the Fed's mandates, people assume that the Fed also has control over it. They do not, in my opinion. I don't think that rates suddenly drive jobs in some
I agree
fashion.
with that 100%.
It takes too long for that to actually come to fruition. So yes, the Fed has to watch the labor market to make decisions on what they're going to do with rates, but their decisions on rates do not directly affect the labor market. So they cannot save it by suddenly cutting rates. That's my 2 cents. The last chart that we'll show in this note, this is the Atlanta Fed GDP Now model. We're seeing, obviously, this tick up again in expectations in GDP. So you see those consensus expectations all the way on the right-hand side for Q4. We're back above 3% GDP growth in expectations. And I think the other really important thing to look at on this chart, that blue bar, which is consumer spending, continues to be a big driver if you look at these later bars. So Q2 2024, so the last half of 2024, and then into the end of 2024, consumer spending continues to be strong, which had been the big question, self-included, about whether or not the consumer would be able to hold this economy up. And they proved that they have.
Guy, despite what?
Despite what?
The consumer spending, despite
I mean, think about what we've talked about. Despite the average rate on a credit card now being 23%, $1.1 something trillion in credit card debt. Delinquencies are now, I think, at 11-year highs. I mean, I can rattle off a few off the top of my head, but the point is, they will continue to spend under certain environments. They get scared when things seemingly go pear-shaped, and what is seemingly the pear-shaped thing is the stock market. A stock market sell-off, for whatever reason, historically, in a meaningful way, for a protracted period of time, it's what scares the bejesus out of the consumer, whether they own stocks or not.
Right. Other than Liz's note on Wednesdays that we get a preview, where do we get that note, Liz? Where can somebody who wants to subscribe to your note, where do they get that?
Well, first and foremost, you can just find it on my Twitter.
Oh, there you go. Okay, so go to Liz.
You can also find it on the SoFi website. If you go to the SoFi website.
Can I say it? Can I do it?
Please.
Or you can
SoFi.com/on-the-money.
Oh, thank God. It's fine.
I love it. That's one of my favorite parts about Wednesday. Go there, sign up, follow her on Twitter, share it, do all the things you want. All right.
That's one where if you hit it's like funny. If you hit like the wrong letter or if you put a dot,
I don't know.
It becomes like it happens before. Like you go to sites where you probably shouldn't be going to. No, it's happened. Anyway, please. Not to me.
So
of course not.
If it's Wednesday, it's Butters guy. Okay, that would be John Butters. He's the senior earnings insight analyst over there at FactSet, our fine partner. Every Friday, his earnings insight blog drops. You can have it also in your inbox, factset.com/insight/subscribe. I don't know if that's much easier than yours, Liz.
Not much.
But,
it's all those slashes.
It's a lot of slashes. You have dashes. They have slashes.
You know what else? And I'm sorry to do this because we got to clip it. It drives me crazy when when you get a password and it's either a 0 or an O.
Yeah.
They should eliminate zeros. No, they don't.
They don't always.
Yeah.
And it's like, how am I supposed to know?
You have to decide if it's a more bulbous O, that's an O.
Jeez.
If it's an elongated oval, it's a 0.
Yeah, but you understand, like, they should just eliminate zeros and O's.
Anyway,
okay, that's amazing. Just give me 1 second.
It's not amazing.
All right, hold on. If it's Wednesday, we get Butters. That'd be John Butters. He is the senior earnings insight analyst over at FactSet, our fine partner. If you want a preview of his note that drops Friday morning, you come here on Wednesdays. Okay. But the other thing is, if you want it on your inbox in Fridays, factset.com/insight/subscribe. All right, guys, this one is really interesting to me. So John just spent weeks and weeks going over a lot of the earnings data, okay, by sector and year over year stuff and all that. Okay. Here, this is one that you have to start thinking about for fiscal year 2025. All right. The bottoms up EPS estimate for the S&P 500 for calendar 2025 is basically $275, which would make a new record high EPS for the index. However, over the past 25 years, analysts have overestimated the actual EPS number by 6.3% on average 1 year in advance. Analysts overestimated the actual number in 17 years, underestimated the actual number in 8 years. Here's the most important part to me. Factoring in the average 6.3% overestimation, the index would report EPS of $258, essentially for calendar year 2025, which would be a record high number. Now, I just want to make one point. If you take the current price of the S&P, it's
6,060.
Is that where it is? I think it's a little higher than
it's
unless it just sold off. Oh, 668.
60,
when I was looking at all right, but when I was looking at before, it was 660. So we sold off a few handles. Okay. If you divide that number
22.
Dude, he's like a little calculator up there. Yeah. Okay, 22 times. But if you take 6.3% off of that 258 number, it's 23 and a half times. Okay, that's just some simple math. Liz, 23 and a half times forward, if you believe
that's high,
that they're 6% higher a year out. Is that high?
23. I mean, 22 is high.
22 is high.
Well, so John also does that work, and you probably find it on his Twitter. I think the 5-year average is about 19 times, the 10-year average about 18 times. So here we are, 22 times, maybe 23 and a half.
Well, and if you've been tracking these averages over time, which John has and Mario and I have too, the averages just continue going up. So when we started doing that and comparing it, it was like, oh, we're way above average, but now the averages just creep up. So is 22 high? Yes. Is 23 high? Yes. What I think many people are expecting for 2025 is that earnings growth comes in at expectations, because that's what we've seen, and that price growth doesn't go up quite as much as earnings growth. So we're expecting average price return, let's say somewhere between 10 and 12%, and earnings growth upwards of maybe even 15%. That would cause a multiple to come down, actually, right? So we could get to the end of next year if that all happens as expected and say, oh, you know what? We're still only priced at 22 times forward earnings. We didn't get any more expensive. But in reality, the market stopped rewarding such strong earnings growth.
So this is what we talked about before we sort of 5,000. And Doug Cass mentioned as well. Less and less. These are not timing tools. But what means is the market has less and less room for error when you get to valuations that are historically rich. And Dan brought it up. It's 22 times at 275, but you can start doing the math. If in fact there's an overestimation, you're talking about 23 and a half, maybe close to 24 times, which, that's fine. Have at it. Brian Belsky talked about not just being an arithmetic equation. However, there'll be a point where if something goes wrong, the first thing market participants will look at are valuations.
Yeah, and just the last point here. So this is like the third bullet. Analysts overestimated the actual number in 17 years and underestimated the actual number in 8 years. So if we get to the 9-year time, you know what I mean? Why would that be? It would be because you're seeing, some sort of margin expansion, accretion to other parts of the market, maybe other parts of tech because of the productivity of generative AI or whatever, if you believe in that. And then that would maybe justify a higher earnings number, which would bring down the multiple, if you know what I mean. Like, so that's that. All right, John Butters, senior earnings insight analyst over there at FactSet. You know where you can get his blog Friday morning in your inbox, factset.com/insight/subscribe. Last thing, we got to do this housekeeping, guy. On Tuesday, December 10th at 10 a.m. What are we doing?
Well, we talked about it earlier.
All right, so we're transforming the financial landscape.
You said that to me like
and revolutionizing
we've talked
technology and workflows. We have the CTO of FactSet. We have the chief business officer at Perplexity. Sign up at riskreversal.com. Be there. We're going to have a great conversation. It will be enlightening. Guy, take us out.
No, not yet. You said, I believe in, like the first line of The Godfathers, I believe in America, if you recall. Yeah. You know what else I believe in?
What?
And I said this for a while. Now you'd be like, you know what, you're really talking. I believe in Led Zeppelin. So Jacob, throw up what do they call that Spotify thing when you get?
They call it a playlist.
Your top artists.
Rap.
So these are my top artists for 2024. No surprise. Actually, the surprise on the list are the Beatles at number 2. But now show the next slide. This puts me in the top 0.5% of Led Zeppelin fans globally. Amanda or Jacob, throw this one up because I have positioned myself where I am a super fan of Led Zeppelin. So there you go.
You want to see mine? Liz, pull yours up because
here it is. Look at this. Look at this.
Mine is.
Look at that. You are a top 0.5% fan. You spent 1,348 minutes together. That's Led Zeppelin.
That's amazing.
What do you like?
Wild.
What do you?
I'm watching mine for the first time.
Oh, you are.
I'm pretty sure Led Zeppelin is not.
I can with a great degree of certainty I can say that. Dan, you want to share your?
Hold on.
Pink.
Go ahead. Keep going.
Pink,
I'm not
did
sure.
You say?
It just highlighted a song that I listen to a lot.
Yeah. So I just wanted to bring
where do I find it? I sent it to my daughter Ellie, and she was so psyched about this. Hold on, give us a second here. Well, this is kind of fun. Well, we have a few minutes.
No, we do.
I listened to over 1,400 artists.
All right, you want to see mine?
That's pretty good.
Wait,
no,
what did you do? Top song or all right, you guys, hold on, Jacob, can you pull this up? It's in the On the Tape podcast.
This is now Dan. Feed. I want people to be clear.
This
has nothing to do with me.
Guy, you may have a fit here. You may have an absolute fit.
It better be Pearl Jam.
Well, here I have two.
Jacob is
now.
Cutting
can I tell you why it's not Pearl Jam? Because I have this thing called Nugs, and it's a subscription.
Is that
service.
Something you can do with the pharmaceutical? You can fix it.
All of says the 61-year-old guy.
Well, I'm
all of the Pearl Jam that I listen to is on nugs.net, so it's not on Apple Music. And so if he can pull up my top albums, this is amazing, and top songs, you guys are gonna love this. And Liz, just put it in the chat because we want to see what you got.
Okay.
What does Jacob have over here? I'd love to see hers. I'd love to see Amanda's. Amanda probably has all these kids tunes, she's got that beautiful 2-year-old
Cece. We said baby Cece's birthday.
Baby Cece's. Let's see if you can pull it up. I don't know if you can. Oh,
so this is your
Dan
top artists.
How do I do this?
Taylor Swift.
I spent how many minutes?
That's Taylor Swift was yours.
You should seriously.
Second was Pearl Jam. Third was Green Day. Fourth was U2, and fifth was Lumineers.
Wow.
What do you think of that?
I don't. I think a lot.
I'm a legit Swiftie. Read yours out, Liz. Read yours.
Top artists: Pink, Sarah Bareilles, Taylor Swift, Adele, Florence and the Machine.
Oh my God,
Florence!
By the way,
and the Machine.
Florence and the Machine. They have Florida is a song on the Tortured Poets. Okay, that is the latest album that came from Taylor Swift. She has a collab guy with her, a song called Florence and the Machine. She's great. All right, should we take it out here?
I'm gonna have to get. Can you take that down, Jacob? Because it's hurting my. It's
Why did you just lose?
Here, I sent it.
You're 50 years into listening to Led Zeppelin. That is true. If you were 61, you probably started legit listening to.
I'll tell you what. No, I'll tell you when I started listening to Led Zeppelin. So I think their first album was 67. I want to say they did like 5 albums.
And you were
3
years old.
I think it was 1973 or 1974
when you were
when I got my first Led Zeppelin album.
You've been listening to them for 50 years.
Yeah.
That's insane.
Why is that?
Did you ever see him live?
I saw Plant and Page at Madison Square Garden.
Which it must have been
at 96, I think.
Yeah.
If I might be off by 95, but no.
I saw Plant open for the Who in 2002 at MSG, and I did get to shake
Jimmy Page's hand. And then you gave me
cool.
the book that I have now.
Oh, I did give you that.
Yeah,
and
I remember
he didn't sign it. He was putting a little Zofo stamp on it. He shook your hand though, but he didn't want to sign.
Legend.
It. All right, so guy, we got to get out of here. We have a 2:00.
Oh,
with Courtney
OMG
Brown from Axios. We're gonna do a little.
Sorry that I was late. It's not my fault. It's the effing assholes who want to see the tree with their dumb fucking bells on their around their neck.
Jacob, we're gonna have to
ho ho ho
Jacob,
and mistletoe.
Jacob, we're gonna have to cut that out, please.